welcome to the extensive weekend video, which is going to be super packed as always. Tariff war, University of Michigan consumer data, very dismal as predicted, and yet S&P 500 was fine, as well as called for clients. So let's dive into the details and predict what is going to be the most likely scenario to unfold next week. Such was the weekly S&P 500 chart that I featured in prior weekend's video on Saturday. I will be linking to it later on so you can review those two prominent support lines. The bottom one has clearly held, as you can see when today's week is in fueling. Market breadth improved, kind of improved. So let's dive further to see how good of a turn it is. 4-hour chart shows that the pattern of higher highs and higher lows is kind of in, and that was exactly the working hypothesis that I gave to clients following expecting profit taking on Thursday and gradual grind higher on Friday, which was exactly what happened, and stocks couldn't care less about additional tariffs by China introduced against the States or about really very poor University of Michigan consumer data. Not even consumer discretionaries as a sector, as we will see further on in the charts, cared all that much. Yields. It was roughly midweek when I was starting to say that at some point in time the US is going to be feeling the tariff war pain as well. It's not just about the rest of the world and how it is forcing the divide of existing trade relations, supply chains realignment, and how it is basically turning Europe into a kind of swing player in the great power struggle between the United States and China. And it is being seen in two charts. This is the first one, where for an opening period of time in this tariff war chapter, yields had been retreating. The US Treasury could have been satisfied. However, it started backfiring, and it was backfiring throughout this week, and not even the Wednesday truth for which I had positioned all clients, whether swing or intraday, well before the opening bell. I will be linking as well to Wednesday's video, where you can review within its 17-minute content why I was calling for significant tail risks for equities to the upside. So yields had been going up and US dollar had been taking a plunge. And frankly, this is not at all surprising. Right now, the point is about restoration of confidence, and whichever money centers are the ones selling treasuries and getting ready to defend their currencies, it doesn't really matter. The point is that US dollar is on the receiving end. I had featured as well the quite prominent suggestion by the United States for China to call them. So this is clearly showing that the United States is aware that the North American financial system, if I say it like this, is under pressure. And nowhere it is as seen as in the bond market. Is it thanks to the euro that the US dollar is tanking? Not so much. It's respectable rise, ascent. However, it's not the main culprit. Safe haven currencies such as Swiss franc had appreciated considerably more than even yen. So, what does it mean about the prospects for yen carry trade unwind? No, just as I had been explaining on Wednesday, the basis trade unwind, this is not on the front burner. Right now, this is about something else, and that's why I'm featuring this bond market chart, where and in other resources it is quite possible to see that the stresses in credit markets have abated ever since the 90-day delay was announced during Wednesday. So this is seen, the lull is seen as well in junk corporate bonds. The ascent Friday was relatively tame, so bonds have stabilized but are no longer plunging, and at the moment they are keeping in with the fragile look of equities, to put it politely. Of course, this is the chart that I will be annotating to clients in depth in their premium stock market section, so that they would be ready for Monday's session. For now, as I say, tentative signs of stabilization. So let's see how it goes and what kind of headlines would we get this weekend. Sentiment readings. Negative, still negative, but have we gotten a true flush? I will be featuring as well volatility charts where we will be more diving into this question and answering it. But for now, the turn has come back towards the slightly more optimistic side at the expense of those expecting neutral readings. So while there is still plenty of bears, the bullish ratio had improved considerably in the week measured to Wednesday, as seen on this sentiment chart. I have been as well featuring this 10 to 2 year spread, and we see steepening following the temporary truce, which however still leaves 10% baseline in place, and both ways punitive tariffs between US and China. This is still steepening, which is not what the US Treasury would want to see. Of course, we all know about the approximately 20 months lead time to recession ever since a reinversion of the yield curve. So we are quite a few months ahead of one such recession arriving. Per historical example. Would it get fulfilled? Would it not? The point is that this slide in equities that we had seen is solely attributable to the tariff uncertainty and turning up the heat as the US is trying to rebalance its books and balance of payments when it comes to international trade. What follows, of course, is the other half, that this will rebalance the capital part of the balance of payments. So these are two connected parts leading to the grand total balance of payments when it comes to the national balance for the United States. And the point that I want to make is that just as the tariff uncertainty and pressures and showdown had appeared, the same way they can be mercurially removed, delayed, resolved, partially resolved. And the sign that I had predicted before the opening bell Friday for clients had been that there would be increased tolerance towards any bad headlines. And that's what we got with the China raising their own rates against the States, with the market quite shaking it off. The same for University of Michigan data. This is financials. Are they breaking down, or are they trying to reclaim the 200-day moving average and to go up as befits a leading sector? This chart speaks quite clearly. Consumer discretionaries barely breaking down or stabilizing purely and finally reflecting the fragile nature of S&P 500 at the moment. There you go. 5-day perspective of the sector view of S&P 500. Of course, this turn in yields squeezing 10-year dramatically higher is nothing very positive for real estate. But technology had been leading off the lows, and while it's too early to talk about the multiples bottom in this case, yes, I'm saying that S&P 500 is showing tentative signs of stabilization, a tradable bottom being in. And bottoming is a process, and weakness can easily, in this super sensitively charged macro environment, can return. The point is to be nimble and to adjust one's trading size when it comes to managing current market moves and current elevated volatility. What else do we see on the 5-day basis? Materials and energy underperforming. Yes, this is the part of worries about global growth going forward, about global recession, tariff-induced one. So, this is what the stock market is telling us, with volatility forming almost, not yet, we are not yet there, but you can almost see the tip of the triangle, and let's see whether we get another push higher to form the ultimate bottom over the short few weeks ahead, or whether this chart will come down and gradually lose altitude by declining. This is the daily chart, perfectly illustrating the fragile nature of S&P 500, first rebound of the tradable bottom. After the wild Thursday's insight day, Friday was clearly up, and buyers retained the control, which was the conclusion that I presented to clients based on the shape of Thursday's candle already. So they had been positioned, and likewise they know my thoughts about what I see unfolding following Sunday's Globex Open. Talking decoupling and talking other asset classes, let's start with Bitcoin, move on to precious metals, oil and conclude this packed presentation. There is still much to come. So we can see that Bitcoin is holding up pretty nicely, and at one beautiful point in time, which is not too far ahead in the future, it will decouple from the way Nasdaq trades, just as it had been most definitely a shock to the US Treasury to see yields jumping so badly to the upside during this week. Clearly, this is the world bond market answer to what we are seeing unfolding in the geopolitical arena when it comes to trade policy so early. And Bitcoin is reacting to that by showing resilience. Budding signs of resilience, I would add. Clearest beneficiary had been precious metals, led by gold, and Wednesday's turn higher after the prior bout of forced selling, which I had covered in the videos, for example, in the opening part of this week, had turned up, and I called this turn one to be respected, and this uncertainty driving up precious metals, see the beautiful miners move higher alongside gold, not lagging. This is another part of what we see happening with yields and US dollar. This is where money is flowing to safe havens, such as gold. First signs thereof Bitcoin, clearly visible in Swiss franc to US dollar, and you see that even silver is nicely rising. Points to be making is about the very high, record or high almost I say, gold to silver, and we know what this means about the either risk on or risk off environment going forward. Again, I will be diving into this aspect further on with clients. Gold, very steady rising line with every intraday dip on this hourly chart being very readily bought. A little bit of a respite on the MACD histogram. That's all I can say about this chart at the moment when it comes to Friday's conclusion. Silver very nicely catching up to the upside, and this is about, once again, the gold to silver ratio, which is flashing quite an important signal when it comes to silver itself. See and compare the MACD histogram itself. GDX, very smashing move to the upside, undaunted, rising volume, fine candles with short upper knot. Excellent, what else to wish for? Oil, I have not been calling it to be anyhow a beneficiary when the worry about global recession is still very much in place. But at the same time, this is not where I would be expecting too much of a downside move. I've been saying that this is sideways to slightly down, somewhat down. And thus far, this is exactly where it had played out over this week. Oil had pretty much gone nowhere after clients caught the great slide to the downside. I would like to remind you that the article, How to Make It in Trading and Investing, I had updated that. So review that because that's part of my mission. Not just to be describing things market by market, but to select what's the most promising, the highest confidence trade move for you to make, given the overall macro and fundamental and technical reading of the situation and where I expect the players to move next. You know that right away I had been calling for Trump's tariffs not to be shallow and not to be targeted, and I had clearly identified that the key response, a retaliatory response, would come from China, and I was eyeing as well Germany and France as the leaders of European Union. Europe had played it smart, saying we are ready to respond with tariffs of our own, but we are willing to consider 0 for 0. So Europe played it smart. And these two engines have refrained from escalation for the time being. So let's see right now, when the US is on the move and China is still very much defiant, where the next headline would come. And given what you know about my reading about the geopolitical situation and efforts to rebalance the balance of payments, and where I see the next moves unfolding in currencies and the bond market, you know, probably where I see the greater tail risk to be at the moment, on the upside or on the downside. You remember as well my point about volatility not yet being clearly resolved on the declining path. So this just illustrates how volatile the market and market moves would continue being going forward. So the best way to play it is by combining the big picture view that I bring you in daily analytics and combining that with quick intraday updates within the respective premium channels. My join page will help you select what's right for you based on what and how you trade. Forget not about Alan's work that he's doing in our stock market channel. You know pretty well my journey. Have a great weekend.